Good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to the Trading Coaches Playbook. I am Wendell. Hopefully you guys can hear me and see my screen and see me as well, I guess, if you really want to. Everything's all right? All right, cool. Thanks, Will. And hello, Brenda. How are you? Welcome, everyone. So this is the Trading Coaches Playbook on this wonderful Friday afternoon here in South Florida. It's beautiful outside. My dogs are actually out there sunning themselves. And we'll go ahead and kick this off. And thank you, Helen. And good afternoon, Kevin. Welcome, Stephen. So just a quick reminder, we're not broker dealers or investment advisors. I gave that up a long time ago. Too many headaches. So we do this for fun and for educational purposes. So I'm not telling you to buy, sell, or hold a particular securities or give any personalized recommendations. There is always risk of loss in the markets. Sorry, it happens. But we can do what we can to minimize the risk. And that's part of what we'll talk about today. And we are not also, we are also not subject to trading restrictions, so we can have a position in a security or initiate one at any time. Anyway, we are very busy here. As you can see, we've got a lot of things going on all the time and like to stay busy. As a matter of fact, I'm going to be talking a little bit about a program that keeps me busy once a day. I know it doesn't seem like much, but it is actually pretty cool. Let me just see here. Word. There it is. Oh, it's probably going to open the wrong spot. There we go. Right in the wrong screen. Of course. Anyway, looking for, there we go, something for you guys. But basically, there's a program that I run called the SPX Cash Flow Secrets. And I'm going to talk a little bit about that today. And if you're interested in learning more, a couple of ways of doing that. One, you can email us and you can basically contact us at support at wealthbuildershq.com. There we go. I just put that in the chat. And trade you and MMM same day. I don't know. I don't schedule a lot of stuff. The mastermind group is the same day as trading you. Yeah. Monster market movers, I guess. Oh, yeah, that's probably a mistake. I'll have to check the schedule. But anyway, with the SPX Cash Flow Secrets, and there's a link for it as well. When you go to that link, it'll take you to this page. It talks a little bit about the program. And of course, if you got questions about the program, let me know. But basically what we do is take advantage of the opportunities that are given to us every day in the options market. You know, they created these things called weekly options. And if you go, I think it's under CBOE. Let me see here. CBOE. That's the right website for it. Yeah. And if you type in weekly, or not, you got to type it in. There we go. Weeklies. And basically, you know, it talks a little bit about the weeklies and the VIX weeklies, S&P weekly options. That's pretty much what we look at right here is the SPX. And it's kind of weird because they call them weeklies, but they actually expire every single day. So they changed them, but they still call them weeklies because, hey, you know, it's what they started as. It used to be once a week for expiration. Now they actually expire every single day at the close of business. And that's something else you got to be careful of. Let me bring up my Thinkorswim real quick because I don't have that open right now. And I'll show you because there are several different types of options that you get into. We have the traditional options, which expire every month, usually third Friday of the month. It used to be Saturday, but they moved it now to Fridays. And then we have our weeklies that either expire every week. Let me just get in there. I'm just going to do paper money so I don't accidentally put in bad trades this morning, which I'm apt to do sometimes when I'm talking. Anyway, but we have several different options when it comes to, I didn't mean to say it, several different choices when it comes to the options. That's better, less confusing. You know, for instance, if I go over to trade, once this loads up, and we can look at SPX, SPY. First, you got to understand when it comes to trading options, and I'll just use SPY quickly as an example. I'm not sure if it mentions it here under the trade grid, but you do see weeklies, okay? And it doesn't say, but typically when you deal with ETFs or stocks, so we got SPY or you got Apple, or Tesla, whatever you want. These are what they call American style options. And with American style options, that means when somebody purchases an option, they have the right to exercise that option, meaning if they buy a call, they can call away stock from someone even before the expiration. Or if they buy a put, actually, let me do this too. I think I have Word open already. So we're going to do this. The wrong thing. I got too many screens open here and I can't see what I'm trying to capture. Oh, come on. There we go. New, blank. And there it is. Okay, cool. So when it comes to options, I'm going to break it down for those who may be newer to options trading as a whole. There's only two options. You have calls and you have puts. And basically, if you are the buyer of a call, has the right to buy or basically call away stock or whatever the underlying security is. Normally people talk about stock. Okay. At the same time, the seller assumes an obligation to sell the stock. So buyers get rights. That's a big difference there. They get rights, and you don't have to exercise rights, right? You get the right to remain silent. You get the right to an attorney. You don't have to use them if you don't want to. That'd be stupid, but yeah, anyway. So with buyers, you get rights, but with sellers, we assume obligations, and you must meet your obligations. Otherwise, there are penalties. So with a put, the buyer has the right to sell stock, okay, or put it to someone else. That's why they call them puts. Okay, and the seller, assumes the obligation to buy it. So not the stock. I mean, unless you're doing options on stocks, I don't know. Okay, yeah, especially when the SEC comes after you. It wouldn't even be them, to be honest with you. It would be the CBO, the Chicago Board Options Exchange, and the settlements. I can't remember the company that does all the settlements, but anyway, they come after you first before the SEC. Anyway, as I mentioned, we have two styles of options. Pardon me, I'm having a bad allergy attack today. I'm coughing and sniffling. Anyway, so as mentioned, American style, which means buyers whatever they want. Before the expiration. So once you buy an option, if you decide, let's say you buy a call and you decide, hey, I really want the stock, it's up to you. You can buy it right away. Or if you buy a put, you could sell the stock right away. Even if it doesn't make sense, you can still do it because you have that right. But the other style of options are called European. And I can't spell today. European style. Okay, I should probably turn on my Grammarly. Oh, no, it is on. It's yelling at me over here. Anyway, European style is when options can only be exercised at expiration, not early.
I mean, I think I have the updated.
And I'll explain why that may be a little bit more advantageous to certain people. Okay, that may be a little bit better for sellers. I'll say
I'll check the pile of
advantage sellers. Hey, geez. Anyway, this one is advantage buyers. And you'll see why in just a little bit. And what you got to realize is, first of all, when it comes to, that's one other thing I want to mention. When I got into my links here, you'll see, we got weeklies, we got the normal option series, which is monthly, third Friday of the month, and each month is represented on the stock. This is Apple. And, if I go into SPY, again, ETFs, and I'm not sure if it shows it here or not. No. But typically, those ETFs and stocks are going to be American style options. So I'm going to go back to my notes. Usually, ETFs and stocks. However, the European style options that cannot be exercised early are usually found indexes. And part of the reason why they're usually found on the indexes is when you buy or sell the underlying stock using a call or a put, there's an exchange of the stock for money. Well, when you have an index, you can't exchange anything. You don't own the index. For instance, I go back over to my charts or everything here and go to SPX, and you see I can look up the SPX index. There's voices in the background. I have no idea who else is talking. That's odd. Shouldn't be anybody else on a mic here.
Oh, yeah.
You see,
And then if we find a place in Texas, if we're settled in Texas, I'll just ask him.
maybe, I don't know, is the admin talking?
You know anybody.
Yeah, Diane. I'll mute her. There we go. Okay. I don't know who that happened, but yeah. Okay, so it'd just be me now. Unless there's my website talking too, but I doubt it. There should be anything else. All right, we're good now. That's weird. Anyway, getting back to this, like I said, index, okay, you're just trading a number. And basically that number cannot be exchanged. Okay, the way that the indexes are settled is by money. Loser pays the winner. And that's how it works. So if an option settles, or sorry, if an option expires, what we call in the money, and can be exercised at expiration instead of an index being exchanged, because again, you don't own the index, you simply get money exchanged. Winner pays the loser, whatever the price difference is. Okay, so that's what it is as far as those go. Now, there's another one that you got to be careful of when it comes to options, and you'll see this from time to time. You have, let me see, what's not there. You get what's called AM settlement or PM settlement. Okay, we typically want to avoid the AM settlement, and you'll see it right there in the option chains. They'll show you, you can see I've got two main, I didn't mean to increase those both, but you can see I've got a May 19, 2023 and a 19 May 2023. Okay, notice the expiration dates, 6 and 7. That's days until last trading day. So what happens with the AM options, like I said, you want to avoid those. What happens with that is really crazy. The options stop trading. Okay, that's what this is right here. It says days until last trading day, not expiration. These stop trading in the evening of whatever date it is. So in this case, the 19th. Actually, no, technically, I'm sorry, this stops trading on the 18th in the evening. You see 6 days left till expiration on the 18th. This one settles in the evening, close of business on the 18th. This one stops trading on the 18th, but the settlement price is the open on the 19th. Why is that bad? What if we have a big gap? You could be a winner when you go to sleep at night, you wake up in the morning and now you're a loser. Okay, that's not good. So that's one of the reasons why I try to avoid, those AM expirations, because we don't know what the settlement price is going to be. So yeah, typically want to avoid the AM expirations. And if you're not sure, make sure you check on your software. This is actually on the index SPX. So SPY, I don't believe has those. No. So it typically has those on the indexes. If we look at OEX, that's the S&P 100. Nope, doesn't have it there either. let's see, NDX for the NASDAQ. Yeah, they're sneaky. And if you don't know, you can get in trouble. There it is again, 19th, AM and PM. Actually, this one doesn't have a PM on the 19th, does it? So you just got to be careful. Make sure you don't touch those AM because of gaps. So basically, when I say avoid, it's because end trading in the evening, but the settlement is the opening price the next day. And it's very easy to accidentally select the wrong one. Okay, you got to be careful there, obviously. Sorry, I got to send a message here. There we go. Meanwhile, the PM settlement, whoops. I'll just say avoid these. There we go. That way you guys can do screen capture and have some notes if you need to. Anyway, these end trading and settle at 4 p.m. Eastern on the day of expiration. Okay, so basically you get that settlement. Why did they create these? I'm not sure why they created those, but they do. And they're there, so we got to deal with them. Okay, so again, you just want to make sure you choose the right options. And again, you could trade the weeklies on pretty much anything you want. It doesn't necessarily have to be the SPX. I like the SPX because it's very commonly traded. You've got a lot of volume. So again, if I go back over, and this is the NDX or the NASDAQ, for instance, today's options, and we want to go close to at the money. So instead of all strikes, we'll just do 6. And right now we're trading at 13,317. So 13,310 we have. Let's do volume and open interest. There we go. You can see there's a little bit of liquidity here. We've got open interest 138. By the way, open interest is how many contracts are currently open and have been traded. Volume is how many have been traded today. So open interest starts off at 0 beginning of the contract, but then can stay at it basically every night when the options close, it reopens the next day at the same number until new options are either created or they're executed or whatever happens, they're sold. Volume starts off at 0 every day and only goes up. So open interest is the total number of contracts currently in existence. And you got to realize options can be created or basically torn up. They're contracts. So, you got to realize there's a couple different actions you could take with options. Number one, you can buy to open. Okay. Well, obviously, if you buy to open, then you would sell to close to either take a profit or a loss. Okay, these would be actions. And it doesn't matter if it is a call or put. It's always the same. You buy to open and then sell to close. Or you could sell to open. Notice I didn't say short because we're not shorting anything. We're selling a new contract that we created and wrote. And then, of course, we buy to close. Well, these people who are buying to open have to buy from someone. They can buy from someone who's selling to close. Okay. No contract is being created in that case. It's just being transferred. If somebody's closing a position, they sell to somebody who's opening, they basically sell the contract. But if they buy to open and somebody is selling to open, that person is creating a new contract. And therefore, open interest would go up and volume would also rise. Okay. If we have two people closing positions, somebody sells to get rid of their position and the person who's buying is closing their sell position. Now, nobody needs the option anymore. They tear up the contract, so to speak, and open interest would drop, but volume would still increase. So volume and open interest are related, but not the same. Okay. Either way, that is a measure of liquidity. You want to see good open interest, enough people trading the contracts, and volume, knowing that you can get in and out of the contract easily on the day you wish to. Okay. So I'm not going to go through all the combinations here right now, but if you're learning options, it's a good thing to understand. Excuse me. So you see on the options expiring today, let's say we do they're right at the money now, right here. We got 138 open interest on the calls, 36 traded. Meanwhile, 190 and 31. So there's a lot of activity at 13,300. But let's compare that to the SPX. Okay, we were just looking at the NASDAQ index. Now with the S&P 500, we basically have this option at 4105. And look at the numbers here. 561 open interest, 1,400 in volume. On the put side, 20,000 in volume, 1,425 open interest. So yeah, basically we have a lot more volume. And here's a little tip. If you see the volume is much higher than open interest, that means people are day trading it. Plain and simple. In this case, there are only 1,425 puts in existence, but today alone, there were 20,000 contracts traded. So people opened and closed quite a bit of puts in comparison to the number of contracts currently open. How about this one? 31,000 versus only 2,200 open interest. Again, anytime you see high volume compared to open interest, and you'll see this on options and futures. And that's a kind of a decent guide to let you know if you could day trade that security. Let me show you an example. If you go to futures, let's say we go to HE, that's lean hogs. So right here, we got the HEM, that's the active contract right now. And we take a look, let me see, I don't think I have, I'm trying to remember. Is it there? No, I'm trying to remember where to see the open interest and volume. Maybe it's under the futures trader on this program. Nope. Pardon me, I forget sometimes on the programs. I switch different programs all the time. Actually, there's an easy way to see it here, believe it or not. If I go into, oops, I'll do this. If I go into the CME group. In a previous company, they taught only buy a contract when you have 100 open interests or better. Do you agree with this? Yeah, I mean, you do want to make sure that you can get in and out of the contract. Let's see, we go to data, volume and open interest. There we go. Now we're going to be able to compare better and easier. By the way, volume and open interest is always delayed by 1 day for whatever reason. But if I go into, let's see, futures only, let's go agriculture, see if it takes me there. Or do I have to go somewhere else? Download data. No, I don't want to do that. I just want to find it easy. Come on. I used to have a real easy website access. You see they have daily bulletin there. Nope. It was the other one. Open interest profile tool, maybe. Heat map, volume and open interest tools. Let's try that. Open interest heat map. That'll be interesting. Let's see. Anyway, excuse me. I got to sign up. Anyway, it used to be really easy. Now I'll just do it this way instead. I'll go into corn and I can go into quotes, and that'll show me volume and open interest, at least volume. Dang it, why can't I find it anymore? It used to be so easy to see. I'm not trying to find the options. Tastyworks, I don't know. I don't have the futures set up on that right now, so I can't. But dang it, volume and open interest. Oh, there it goes. Volume and open interest again. There we go. Agricultural asset, volume and open interest. And it's not what I wanted. I apologize. I should have been better prepared. I was just trying to show you a contrast between a slowly traded security. There we go. I was trying to get lean hogs. So there, we'll do that. And volume and open interest. Okay. So now you can see on the front month contract, which is currently June. Okay. We have total volume 30,000, looks like, and open interest 62,000. So that's not bad, but you can see that these are being held longer term because the volume is half of the open interest. But when you go to another security, let's say the S&P 500, volume and open interest on that and you see the June contract, first of all, open interest 2.2 million. And so far the volume is 1.4 million. So it's much, much easier to get in and out of that security. That's my point. When you're looking at futures, you got to be careful, because if you have very light volume or very light open interest, you don't want to day trade that security. It's best to try to day trade something that has very high volume, maybe even higher than the open interest by the end of the day. At this, this is during the day, so we're still building that right now. Anyway, getting back to the options, I was trying to show the volume and open interest. It will show it on the options here, and you can see how low they are, right? I'm not necessarily going to want to trade options that expired today on lean hogs because, well, 759 open interest on the puts, but only 37 traded today. Over here, again, open interest is not too bad, but there's no volume. So it would be very difficult to get in and out of that security, and the spreads will be wider. So, it all comes down to, if you take a look at the SPX, especially when you're dealing with the dailies or weeklies, as they're called, you will still have very high volume and very high open interest, and you don't have a problem getting in and out of the security. And the spreads are typically much tighter, meaning you can get better pricing. All right. So yeah, SPX it'll show SPX on Tastyworks, that's for sure. If I go back to my browser, bring it up. I'll log into this account. There we go. And trade. This is for options again, but I don't know if it'll show me HEM 23. I'm not sure the symbol for the futures. I usually just use this for the SPX anyway, but all right. So getting back to my discussion, basically there's two things you can do with options. We talked about this at the very beginning, right? We talked about the different styles of options. I like to use, first of all, PM settlement only. So I'll boldface that one. And I like to sell options. And I also like to sell European style, because if I'm going to be selling options, I want to sell the one that has an advantage for European sellers. I'm sorry, the advantage to sellers, and that's the European style. Why does the European style advantage to the sellers? Because remember, sellers are assuming an obligation to do something. Doesn't matter if it's a call or a put. Buyers get the rights, but sellers assume an obligation. And because of the European style, and those options can only be exercised at expiration, that means if you sell, you do not have to worry about early expiration, or sorry, early assignment or exercise. Okay, exercise is when the buyer decides they want to do the buying of the stock or the selling of the stock. Assignment is when the seller is notified that they have been chosen to meet their obligation. So let me put that right here. Okay, exercise. Buyer chooses. So I get the mic on again. I remove permission to talk on that one. Sorry, there we go. Somebody just did a cough. How do you know if it's European style? Mostly indexes are. You can look it up typically on the options, either looking at the CBOE website, or you can look at the on some of the platforms will tell you as well. So yeah, it just depends on which platform you're trading on, if it'll actually tell you or not. Anyway, the exercise is when the buyer chooses to buy or sell the underlying. Basically, they exercise their rights from the contract. Meanwhile, assignment is when the seller is picked to meet the obligation. Okay, and as a seller, you typically don't want early assignment because it could put you at a disadvantage. Most option sellers end up selling without having the full amount of capital available to actually buy or sell the underlying security. They trade on margin. Okay. So here's a big reason why I like to sell options versus buying options. It's about probabilities, right? It's all about probabilities. As a matter of fact, I'm going to go to my little doodling tools right here. And let's see. Oops, now I want to line. We'll do this. Give my art skills a little bit of work here. There we go. So we'll say that we are looking at an option where, and we'll change the color. There we go. Now, if you know anything about options, we have these things called risk graphs that tell you how you make money or how you lose money, right? So let's say you buy a call option. We're going to keep it simple. We're going to buy a call, and the strike price is $50. So let's say we're going to buy a $50 call for $1. Okay. So what that means is we have the right to buy whatever that stock is for $50 by the expiration of the option. However, we paid $1 for it. So our cost is $1. This area, that blue line, is going to be our break-even point. That's where we make no money or lose no money. Okay, we're basically just break even right there. Now, we don't start off at break even because we paid $1 for the option. And when you buy an option, you cannot lose more than what you paid for that option. So our max risk in this case is going to be that $1 that we paid for the option. You know, it's like if you buy a coupon or a coupon book and you don't use it, you lose what you paid for the book, right? Now, if we get the price right here to $50, we could buy the stock for $50, but that doesn't really help us because we paid $1 for that stock, which means if we buy it at $50, we still lose the $1, right? So how do we break even? Well, we only break even if the price goes up. When you buy a call, you only make money when prices go up. As a matter of fact, we need it to go up to $51 because now if we buy the stock at 50, right, based on our contract, we have the right to buy to $50, even though it's now trading at $51. Well, let me draw straight. That means we'll make a $1 profit, right? And that covers what we paid for that option right there. Anyway, I'm not going to go too much in depth with this, but obviously you can keep making more money the higher it goes. If it goes to $150, you get to buy it at 50, sell it at 150. But that means the only way I make money by buying a call option is if price moves. Can't type. Far enough, fast enough. Remember, time is a factor here too, because when we buy an option, it starts decaying in time and value. Time is money when it comes to options. So it has to move far enough and fast enough. If prices go sideways, we lose. If prices go down, we lose. And the same thing happens with a put. Okay, so basically, if you buy an option, okay, you only profit if price moves in your favor fast enough, right? And prices can move one of three ways. That means you have a 1 in 3 chance of profit. Now, compare that to somebody who sells the option. Okay, now when you sell an option, your profit is one thing and one thing only, the premium you collect. Right? You can't make any more. You can make less, but you can't make any more. Technically, your risk is unlimited, but you have limited profit. Okay. But here again, we're playing the probability. And basically, we make money, we profit if price moves in our favor. Right. So if we sold this call and prices went down rather than up, we make money. We also profit if price moves sideways, meaning it didn't go in our favor, didn't really go against us. It did nothing. Which, if you've been looking at the S&P 500 for the most part, it's been doing that for quite a while, right? I think I even have a chart available here. The wrong page. I have too many things open right now. Wow. But here's the S&P, and if I go to a daily time frame, clean this chart up a bit. Look what's been happening for the past couple months. That's April, May. Here we are. Well, maybe over a month. We've been stuck sideways for a bit, right? So if you're a swing trader, this has been torture. But if you're a premium seller, it's been pretty nice. Day trading is not bad. Obviously, if you look at a 15-minute chart, you can see that day traders made some money shorting today and would probably bounce a little bit. We'll make more money on the way back up later. But if you're looking at longer term moves, it didn't go anywhere. So as I was saying, if prices move sideways, you still make profit. And if price moves slightly against you, you make profits, right? Because you might make a little less, but as long as it doesn't go beyond that break-even point for the buyer, which is also your break-even point, you still make a profit, which means you have 3 different ways of making profit. Now, I'm no math wizard, but I think that 3 ways of profiting is a little bit better than 1 way of profiting, right? That's one of the reasons why I like to sell options. So what I'm looking to do, basically, as I said, I can go into these, again, they're called weekly options, but they're really every single day. So here on the SPX, you've got these dailies. One expires today, which is Friday. We have Monday, Tuesday, Wednesday, Thursday, and then Friday, obviously skipping that AM. And then again, Monday, Tuesday, Wednesday, Thursday, Friday. And there's plenty of liquidity to be able to do this. So what I typically do is go out pretty much every day. And you can see I've got my charts all lined up right here with a bunch of different zones. This one was actually tested yesterday, so we broke it today. And I'll clean this one up because we broke that on the gap up today. Excuse me. Yeah, it's not fun with allergies. I'm struggling a bit, but basically I look at a couple different time frames here. Oh, not all. Wait, hang on. There we go. I look at 5-minute and 15-minute time frames because I'm trying to trade intraday. I also keep in mind the bigger time frame trend. And you can see I'm worried about things that have been tested before. And what I will do is simply sell options outside that area. And the reason why I want to do that, say, for instance, I sell puts down here. Remember, you buy a put if you think prices are going down, but you'd sell the put if you think they're either going to go sideways or bounce from a demand zone. And up here, I would sell calls. And again, the reason why I would do that is I expect the prices not to rise above that level. Now, you can't, it depends on who you are and how much money you have. You typically can't just sell a call by itself or sell a put by itself. If you do that, you theoretically have unlimited risk. If I go back to my risk profile, if I sold this call, that price could go up infinitely. So instead of simply selling a call, I want to protect myself and lock in. If prices go too far, I want to cap my risk at a certain level. And the way you do that is by selling a call and then buying a call. And you can do the same thing with a put. So if you basically sell a call and buy a higher strike call, That is something called a bear call spread or a credit spread. And basically what we're trying to do is profit from the premium collected, but because we buy another option, we're reducing our risk. This will be available to review a little bit later. We usually post these on our YouTube channel. So I'll make sure that they get these posted. They are a little behind on posting them, but they will eventually. So if you go to the YouTube channel for Wealth Builders HQ, they'll be there. And of course, if you want to learn more about all this, you can always join me at the SPX Cash Flow. So anyway, that is the bear call spread. And then for the put side, we can do that as well. We would sell a put and buy a lower strike put. And that is a bull put spread or a credit spread, a bullish credit spread for puts. And basically, we're expecting prices to stay above a certain level. That's why we're bullish using puts. Now, if we combine the two, that creates a new strategy. Basically, we want prices to stay within a certain area, and that's called an iron condor. That's all. You're just combining a bull put spread and bear call spread. So the nice thing is, I use Tastyworks a lot of times. I'm on the wrong spot there again. But I use Tastyworks to kind of create some of these positions because they have a visual representation here. For instance, if I go to my strategies and, well, we'll just do the calls and puts separately. I click on short call vertical first. Okay, and actually, before I forget, log in. Might as well give you this too. One-time cost for the iron condor is the same for the credit spread. Yeah, I'm going to get to that. Oh, come on. Yes. I don't have any money in this account. It's just for demonstration. Oh, wait. No, I don't want to do that. Maybe I already have it. What the heck? I was trying to go to the home page to show you something. I'll figure it out later. I don't want to waste too much time. Let me see if it's over here. If I have it. And of course, my dog's barking in the background now. Dang it. Why can't I find these things? It's driving me nuts. Anyway. The log out account. All right. Anyway, I want to get back to this right now. Again, if I'm finding a zone, let's say and these are not necessarily the zones I'm going to use today. Okay. But if I'm looking at 15-minute levels and trying to find an area where I could sell above, let's just say I use this one I've already done. Okay. It's 41.53. If I don't think prices are going to go above that area, I could sell the calls above that. So I go to my bear call spread. I have to go to the 0 days till expiration. That's basically the options that are expiring today. And again, it was, 41.53. So I go to 41.55 and 41.60. I'll zoom in a little more to show you what's going on here. Unfortunately, there's no premium available there. Okay, you can see that it's just not worth it yet because it's too far away. It's an 84% probability of making money there, but it's way too far away. Okay. The nice thing about this program is you can see, hopefully you can see this, the green shadow shows me where I'd make money. So as long as we stay below 41.55, I'm going to profit. If we go above 41.55, that's where I start to lose money. Why not use the ETFs? Great question. That is an American style option. And because it's an American style option, I run the risk of getting exercised early. With the European style option, first of all, this is a cash settled index. So at worst, if this does go what we call in the money, I could still make a profit even if it doesn't go all the way past the second option. So I can still make a profit even if I'm wrong. However, if I'm right, which I am most of the time, fortunately, then I get to keep the premium. And I don't have to worry about early exercise. This is what I was going to send to you guys. Here's a referral link if you're interested in opening a Tastywork account. I'm not necessarily recommending them. It's just, I like the interface is kind of easy to see here. So I could do the same thing, as I said, for the demand zone, although right now we're kind of close, but let's say I was going to do 40.90. I go to the puts. Again, make sure I have the right expiration. And 40.90. And 40.85. And you can see I can collect a $1 premium, 61% probability. And that's not great, but why don't I use longer time frames? Because the zones are typically further away, and I have to find a good balance between high probability and collecting premium. Notice the further away I go, the less premium I collect, but the higher probability of profit I have. Also, you'll notice, or maybe you didn't, but I'm going to tell you, I'm using 5-point separation between the option I'm selling and the option I'm buying. That means if I lose, I can never lose more than 5 points or $500 in this trade. But since I'm collecting some premium, I actually reduce that risk. Okay, because you get the premium no matter what, even if you lose. So right here, I'm collecting 75 cents, 65% probability. And if I put in that trade, I only need $425. It seems like a really weird ratio because you make 75 by risking 425. But because the probability is higher, it's not that bad. It's a high probability because remember, I make that money if prices go up, sideways, or just down a little bit, as long as they don't break that level that I expect them to bounce from. And I'm actually higher than 65% if I'm using an actual demand zone I'm using or looking at. If I wanted to make more money, I could widen the spread right there. Now I've got $1.40, but I have to come up with $1,355. Now that might be worth it if the reward risk ratio or the rate of return is better. But if the rate of return isn't better, then obviously I don't want to do that. Okay, remember we were looking before at, oops, I don't have it open, calculator. And right here, 145 divided by 1355, we're at about a 11% rate of return on the rate of return on the money we're using. But if we made 75 on the 425, we're at 17.6% return. So yeah, I try to go typically with only a 5-point spread. And now here's the cool thing. What if I could do both? Again, I use the bull put spread and bear call spread. Instead of doing it separately, now I do it as the iron condor that I mentioned. And again, go down to 0 days till expiration right there. Bring this down and bring this up. Okay, actually, let me go back a little more here. I was getting about 75. Can't remember what it was. I mean, it was closer. I do sometimes leg in, meaning I put in one side and then the other. Other times I'll just put it all in as one. But here's the cool thing. Sometimes I can do both sides and collect more premium. I think we're up here somewhere. So there I can collect a little more premium. My probability is a little low though. But notice the amount of money being put in is not any higher. Oh, no problem. Take care, Brenda. It doesn't cost me more to put in both sides versus only one side. Watch. You know, this is 80 cents for both sides. And again, I had to come up with about $420. But if I go and take out the calls and only do the puts, look at that. I have to come up 460, I only make $40. So I'm able to use a little bit more money and collect premium on both sides. And when you think about it, prices can't go up and down by the end of the day. So only one side could lose by the end of the day anyway. And there are things that you can do to prevent yourself from losing too much. You know, we actually have some documents in the SPX cash flow that talk about, first of all, how to do this. Number one, you know, you got to learn how to do this properly, how I find zones. So I don't think I'm logged in, but let me do that real quick. If I go into my SPX cash flow secrets, yeah, I definitely try to do the iron condors almost every trade because That's the same amount of premium I have to put up, right? And I typically can make more money. Oh, I hate when it does this. I got to log back out and log back in. It'll only take a moment. There we go. Log back in. And while that's going, I could show you, this was March, and actually track all the trades. So you can see how we do. You know, I've got the totals right here. We had, for the month of March, 36 winners, only 5 losers. So my win rate was 87.5%. That's pretty darn good. You know, we have to make it high because the average loss is always going to be larger than the average win. And when we take a look at what style of trades that we do, you'll see IC is iron condor, BPS is bull put spread, BCS is bear call spread. Most of them just simply go to expiration. Some of them, this one expired out of the money, we were stopped out, but I keep a tight risk reward ratio. And again, everything's documented how to do these. If I go into the SPX cash flow, there's it, SPX cash flow secrets, there it is. So if you become a part of that program, you actually get all this information. There's educational videos that teach you my trading routine, how I find zones, SPX cash flow secrets, the actual strategies we do, vertical credit spreads, how to do them, and even how to do them on things like Thinkorswim and Tastyworks. I'm going to add some more videos there. I also have documents that support this and show you step-by-step how I do these. And as I mentioned, we track pretty much everything we do. So if this was March, let's see, where is April? I've got that too here. There's April, bring it up. So you saw in March, we did pretty well, 87% winners. And wait a minute, March was a total win for the month. And this is only doing one contract. This is very scalable. But if you did one contract, the profit was $1,627 total. Okay. Sometimes we do take the loss if it's a stop loss, as you can see. Other times you can roll over. That's a personal preference. And then last month wasn't quite as good because I don't think we had as many trades. That's all. And I had a couple bigger losses. That's all. Let's go 200% there. No, we don't need to go that big. But we had 29 winners, 4 losers. So it was right 87% of the time. The problem was we took a couple of bigger losses, but we came back and we were positive for the month. So again, if you just increase the size, one contract takes no more than $500 of deposit for the premium. I'm sorry, the margin. And that's whether or not you take one leg or both legs for the iron condor. It's the same. So we look to see what the trend is doing. And what I do is I send out a text message every day at 2 p.m. I usually put out first a text that tells you where the zones are that I'm looking at, both on 5 and 15 minutes. And then I also put out a trade idea. And it's usually, like, well, it's not usually, it is, these trade ideas, you can see they come out right around 2 p.m., sometimes a little later if there's an opportunity, but most of the time right around 2 p.m. And I actually have this. You can see how we've been doing since the inception of the program. Started in November of 2021. I've been trading this a lot longer than that. And these results are not including commissions, but commissions are relatively low. Typically, you'll pay less than $1 per contract, and you do not have to pay a commission to exit the position because we're allowing the positions to expire typically. So we did pretty well. 2022 average, let's try to see, win percentage was 83.97%. This year so far, we're 84.63%. I guess it's because February is a little low. I actually have not added April's in there yet, so I got to do that as well. So what happens is, as I mentioned, you get texts, and it shows right here, you can do the SMS text opt-in, and I send out multiple texts throughout the day. I send out the levels, the trade idea, and then how to monitor the trade, or if it's hitting the stop loss, I send out a message there as well. So I basically watch everything and monitor everything for you, kind of spoon feeding you the ideas, and you just follow through. That's pretty much it. So if anybody has any questions, I'll let it go there. And again, I got to update this. What do we have? 29.4. I'll just move this off to my other screen. I can update this other sheet, which is the yearly tracker right there. I had 29.4. There are no 0 entries here. Why did that not go? There we go. The stop is based on the premium collected, yes, or breaking the zones. But typically what I'm looking at is my risk is 2 times the premium I collect. And let's see, 49.48. This was April. Excuse me. And unfortunately, this was kind of large, 217.50, but there weren't that many losses, so that's not a big deal. 7.88. And actually, I don't care too much about delta, to be honest with you. And buy between 65 and 90 delta, that's putting you in a direction. I don't know why you'd want to do that, especially if you're doing an iron condor. Iron condor should be very low deltas. If you're not familiar, delta is a risk management based on the directional movement of price. The lower the delta, the more neutral you are in price movement. And if you're doing an iron condor, you do not want to be biased. One leg trades, the problem with going with a very high delta of 65 to 90 is you're paying too much premium and your rate of return is poor, or you're not collecting enough premium. Because if you go with a very high delta, you're going deep out of the money. It'll be very high probability of win, but you're not going to get much. That doesn't make a lot of sense to me. Again, if you go in, I'll show you here, as a matter of fact, if we look at a vertical spread, and right now I'm on the SPX, we're currently at 41.04, but let's say we're going to do something below the current price. Let's say we're going to do 40.80. Okay. So at 40.80, it's not showing any more strikes. There we go. 40.80 right there. If we were to sell the puts, it's 50 cents right now. And let's go into, I'll bring in all the Greeks. Actually, do this. Probability. I'm sorry, 40.80, 40.75 is 35 cents right now. It's cheaper. Okay. But the delta is negative 0.04. Wait a minute. Oh, it's selling. So that'd be, yeah. I don't know how you get that high of a delta when you're doing the one leg for selling. The trades are definitely credit spreads, not debit spreads, right? I'm doing credit spreads. So yeah, I'm not sure how you get that high of a delta using just one, using this one leg out of the money. I mean, you have to go pretty deep out of the money for that to work. Let me go to all here. These are way too far out. And what happened? It froze. Do I use expected move? In a way, yes. I mean, I really just keep it simple. There's so many different things you could definitely look at, but I try to keep it simple and simply look at supply and demand, because that was what works the best, right? And 2022 worksheet results. I never finished this here. Let me see, 565. I'll get the others in a moment. 2022 was pretty good. The average return was $800 per month for the average return. Overall was $9,700. Oh, just buying a call or buying a put. Yeah, again, I don't buy calls or puts with that much delta. You got to buy deep out of the money for that. And again, you're paying too much in premium. 65 to 90 is crazy. Yeah, you'll have a very high probability, but you need a huge move to overcome the premium. And if you're buying a lot of time, you're also spending a lot of money. Now, if you try to buy a lottery ticket, which is a deep out of the money option that has a high, deep, out of the money option, you'll have very low delta until it starts going further in the money, but you don't pay much for it. So that's not a good either. I don't agree with that. Trying to go for 65 to 90 delta, I typically want just slightly out of the money. So maybe 65 for buying an option. But again, I'm mostly on the sell side anyway, because I want higher probability rather than trying to buy the option and go in and hope it goes in my direction. So the nice thing with selling the options is you don't need them to go in your favor. You don't even need them to hit a level to make profit. You just need them not to go beyond a certain level, which again, you got 3 probabilities of making money. So the trades are usually entered right around 2 p.m. Eastern. And again, there's text messages that are sent out. So I'll be doing that now in the next hour. And as you can see, we've done pretty well. So anyway, I'm past my time. The latency, once you receive the text, from the time I type it in to the time I send out the text actually sends out is less than 30 seconds typically. And then however long it takes for you to put in the trade, obviously. But if you're expecting it right around 2 p.m., and I usually send out a warning text saying, hey, this is information for educational purposes. I'm not recommending anything. So you know it's coming pretty soon. So you can go to your mobile phone and log into your platform. It's pretty easy. So yeah, you might not be able to get the exact premium that I receive, but you should be able to get pretty close. And when I look at these numbers, and often what I'll do is I take a screenshot, and you'll see, let me bring this up. Oh, I grabbed the wrong piece. Oh, come on. Zoom is covering it up. But right here, if I go into, see, desktop. No. Hang on. There it is. And cash flow. So for instance, yesterday, I do screenshots almost every single day. So yesterday we go to 5/11. And there we go, 5/11. This one was a little bit earlier yesterday. You can see I took a picture with the timestamp on my computer and the option premium that was available. That one, I can tell you when it actually was received because I received the text as well. There's my SPX cash flow. The text for that one, that was the 40 cent on 40.95, 4100. That was received at 1:35. So there was a 1 minute lag between the time I sent it out. I don't know if you're going to be able to see it in the camera, but on my phone, it shows 1:35 p.m. So I try to take the picture after the text is received, but sometimes it's before. It's pretty close to it though. And then after that happens is when I usually try to take the trade myself. I don't want to front run anybody or get accused of that. So my personal accounts could be audited if need be. I'm not front running anything. So anyway, if you got any questions, let me know. If you decide you want to enroll, one of the things I do, and it's pretty much for all my programs, in the SPX Cash Flow Secrets, if you decide, that's the wrong page, sign up, there's two different subscriptions. There's monthly, and then there's quarterly. And you see the quarterly, I obviously am way above that in the rate of return. But what happens is there's a free 2-week trial. You could try this out if you sign up for the quarterly, and there's no charge on your card for the first 2 weeks. You just get to basically experience everything, get the text for 2 weeks, try it out if you like it, see how it works. And if you don't like it, you just cancel and there's no charge. If you do like it, then you just let it go and you get billed quarterly, and it just continues to stay at that price no matter what until you decide to cancel. If you do the monthly, same thing, you're just locked in for a month, but there's no 2-week free trial on that one. Free trials only on the quarterly. So I don't know what that comes out to. What's $6.95 divided by 3 is $231 a month. And where's my annual stuff there? Annual return. That's totals. Oh, average per month is $896 so far this year. Even every month, you can see I beat the monthly, which if I didn't, it wouldn't make sense. Some days, some months are not so good. We had a bad month, but followed up with a great month. But the average is well above the monthly costs, which is what you need in order to be able to make some sense of something, right, as an investment. So, yeah, you can save 100. Is it 190 a quarter? Yeah, I guess you're right by doing the quarterlies, and you get the 2-week free trial. So you did the math faster than me. Anyway, I got to run because I got to take care of the text coming out, and I got to do my analysis soon. I got to make sure I got the right trends in the right zones for my students who are there. But if you're interested, you can sign up as well. We also do meet every other month and do an educational session, an open Q&A. If you are a member, there's also, you can send me messages and get back to me, or I get back to you almost immediately as fast as I can. So I want to thank everybody for being here, and I appreciate your time. So until next time, trade safe, trade well, everyone, and take care.